Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hey everybody, welcome to the 14th edition of Carson's Facts versus Feelings podcast with Ryan and Sonu. Sonu, we have an extremely awesome guest today. We're going to talk commodities with Kriskey, the chief commodity, I think I butchered it already, didn't I? The commodity strategist at Invesco. Kathy, I wrote it down and I still messed it up. But all I know is you know everything about commodities. Let's just go there.
Thanks so much for having me, guys. Excited to have this conversation.
No, this is going to be a lot of fun. We're really excited. I mean, Sonu, I'll let you ask the first question in a second, but Kathy, I'll give you hopefully the easiest question we're going to hit you with. What exactly do you do as the commodity strategist at Invesco? How do you help investors and help the industry understand all the crazy stuff that's happening out there?
That actually is a great question, and no one has ever asked me that. So a lot of what I
Wow.
do is I have to one have a view on the markets, right, and stay well informed, but also to educate people on commodities, and that's what Invesco has taken very seriously. This is an alternative asset class, right, and a lot of people have not been in it, if at all, but 10 years ago is typical for investors. And remember, we didn't have inflation, so there was really no need for 10 years for people to understand commodities. But right now, the education is the key. So we create a lot of material and we spend a lot of time on calls and speaking at conferences, and that's our goal. And that's why I was glad you guys could have me here today. Is when your goal is to educate others, what better way than to do a podcast with you guys? So really appreciate this.
No, absolutely. So for 10 years, you were just kind of in a slumber, kind of like a bear during hibernation, but now you're back, right? Is that what you're saying?
Well, I've been on the sell side most of my career, so I'm embarrassed to say, like, probably 30 years in commodities, but all of that was sell side. So coming to
Yeah.
Invesco, I've been here almost 2 years in March, and this is my first buy side job. And again, hitting it right with commodities. It's a lot of fun to be talking about commodities, for the past like 2 years.
That's a great time to be doing it. A lot going on. Sonu, I know you've got a list of questions. I do as well. Kathy, if that's all right, we're just going to start firing away with some questions on Carson's Facts versus Feeling podcast. Sonu, first one, take it away.
Yeah, no, thank you, Kathy. This is we always talk about stocks and bonds, and it's nice to shift direction a little bit, especially given we've been talking about inflation. Kathy, you mentioned inflation. That's what we've been talking about all year, and a big driver of that has been energy prices, right? So I just thought maybe we can just start with a lay of the land, like how far we've come this year alone. Like oil started the year at about $75 a barrel. It hit $125 a barrel in the summer. Now it's back where it started, right? So let's talk. Maybe you can give us talk about what happened
Right.
and
And
where
it's
we are now.
been very interesting, right? And there was a great research piece that I like to quote because it helps very succinctly describe what's going on in energy. And it's called the triple deficit, right? And it's easy to remember triple, right? So, number one, low inventories. We have historically low inventories. In commodity world, we always look at the 5-year average. We are dramatically below the 5-year average on crude oil and diesel, and we're just in the 5-year average for gasoline, right? So, number one, low inventories. Number two, low spare capacity, right? You think about spare capacity in energy is like a cushion, right? But we've sort of lost our cushion because the cushion came from like Saudi and, UAE and maybe a little bit of Kuwait and also US shale, right? But now the spare capacity is a historic low. So that cushion is basically gone. And then lastly, low investment, right? And I feel bad, right? The energy producers always say, like, we're the bad guys in the story of energy transition, right? And so like pension funds were banning like investments in fossil fuels, so when you're not getting investment dollars, right, why would you grow your production, right? And that's why a lot of people pointing to this sector like the producers and the refiners, and I don't want to say it's wrong, but generally we need investment in energy because the most important thing we've learned about energy is we need redundancy, right? When you don't invest enough in one sector, right? Then the inventory goes down. Then of course that actual thing that you're producing, the price adjusts and goes up. And that's why people talk about the energy transition and like how, oh, energy transition is going to be bad for commodity prices. I was like, actually no, that's the thing that investors get wrong. The energy transition is actually bullish prices. It might not be bullish all the producing companies, but it's definitely bullish the prices. And that's a problem. That triple deficit is what got us here. But this has been going on for years. So, and then what happened, right? Last year, we had that story of coming out of COVID, right? And I think it was interesting because we had increasing demand, but constrained supply. And that was a frustration because we were looking at China for the metrics, right? China got COVID first and apparently has COVID last. But when they came out of the COVID lockdowns initially, the US producers were looking at like, okay, what are those metrics? And they did the exact reverse of what we've done in America, right? They just drove to and from work. Americans, we were staying home from work, but we were driving everywhere else. I live in the Northeast and I joked that everyone I know drove to Florida for the first time, right? So it's like a 2 day journey, a lot of gasoline being used, right? So what was the number one commodity last year because coming out of COVID was gasoline, right? It had crazy performance because of that increasing demand with constrained supply. This year, a lot of the story has been diesel, right? That we are running out of diesel fuel, which we're not, right? But it was a concern because remember, the demand for diesel comes not just from used as a heating oil, but for trucking, right? Everyone learned. I joke, I have a 93-year-old father. He's like, yeah, I just had this stuff shipped to me. It's a miracle. He's from Ireland. I have to do the Irish accent. But it is like everyone started getting things shipped, right? So that was massive diesel demand. And again, constrained supply. So I think that as we had this year, we were off to the races, right? We were up 40% into June, right? Because we had, again, the big investor demand for diversification in January. Then we had Putin's invasion into Ukraine in February. And people are like, oh my goodness, we're short. These natural resource countries are being impacted, and we were off to the races. But what happened in the middle of the year that sort of changed everything was China lockdowns, number one, and then SPR release, right? And now that SPR release was so big. It equated to 1 million barrels per day, right? And it was supposed to end in October, but now it's not ending till December 31st. But I heard a metric that I think is very impactful in that if Biden had not released those SPR barrels, crude oil would have gone to $130 per barrel, right? So higher, Sonu, than what the high that you just mentioned, right?
And
So I think people are not aware.
SPR is the strategic petroleum reserve, right? That's
Exactly. Right. And that's where, again, a lot of people now are like, wait, what was that strategic petroleum? Why did we release it? And it almost, so remember, like the Biden administration was being a sort of painted with this, like, you're the inflation guys. Right. Now, there was
Mhm.
very little that had to do with the administration's actions that caused any of this inflation. But the one tool that they had, and it was a blunt tool, was the SPR. Right. And they 1 million barrels per day is massive.
Kathy, can I
Right.
jump in just for a
Oh,
second?
sure.
Where is that? Where when we say SPR, a
Oh,
million
it's
barrels a
all
day,
over.
where do
It's
they
yeah.
keep it all?
Yeah, that's a good question.
Good
I can't even
question.
remember, but I know that it's like
Make
it's
something up. It's okay. Yeah.
strategically no, it's
Yeah.
strategically placed like different places, but mostly in Texas and Louisiana,
Okay.
right?
Okay. Got it.
But it
Understood.
is important. And remember, no one we don't normally the SPR is used for like a crisis, right? That like there's a war or we need something that's going to take barrels off the market. It's not used typically to manage, let's use it in quotes, prices, right? And that's why I think OPEC was a little bit, I wouldn't say frustrated with the US, because now we are, net a consumer of energy and we're like, okay, we're going to release our barrel. And other countries were releasing their barrels too, right? Because it's like the price kept going higher and higher. And like, what can we do to stop this? But normally what happens if price, that whole phrase, like higher prices are the cure to higher prices, whatever. And the problem with that is that if we falsely keep prices lower, then we don't have demand destruction, right? So we did not see real demand destruction. And that's the problem is like it was held falsely low. So now the SPR is going to be done and they have to buy back those barrels. Right. So one of the analysts was estimating that, the need to buy back 60 million barrels in the first quarter of next year. And their target is between $67 and $72. So we're around that level now. So is the U.S. government going to start purchasing these barrels? And if they do it, they'll probably do it quietly, which makes sense because they don't want everyone to know, like, they're back in $15 higher. So, but it's going to be interesting to see how they refill those barrels. And so that is, one slightly bullish thing that could be happening and should happen next year.
So, Kathy, that was awesome. I got a feeling we can ask a couple more questions. You can just fill up all the time with your knowledge. This is amazing. But one thing that came in my mind, and again, this isn't your average podcast. You said you're from Ireland, right? You a Guinness
My
fan? You drink
parents,
some
my
Guinness?
parents, I do
Well,
not
you're
drink
not, but your
Guinness,
parents. I
but
didn't
my
mean that.
son,
Okay.
my
Okay.
son is at Notre Dame, so
Oh,
I think
wow.
Mm,
Well,
every picture of him
okay.
is holding a Guinness. Yeah,
all
it's
right.
not good.
Understood. So let me ask one here. I mean, you mentioned China reopening. We kind of glazed over it. Let's dig in a little bit. I mean, is it as simple as when China goes on as many lockdowns as they had, lockdown, shutdown, come back a little bit, that is impacting along with releasing 60 million odd some barrels from our SPR?
Yes.
How much does China really matter to the price of crude? Is my question, I guess.
Yeah, that's a great question. And so we estimate that they're going to come back in buying about like a million to a million point two million barrels per day, right, of crude oil as the reopening happens, and that equates to about $15. And that's a general rule. Like a million barrels equals about $15, right? So that's why when OPEC does certain things, or the U.S. or anyone's doing something that's going to impact prices, million barrels a day equals $15 move. So that's what we're estimating. China coming back is going to be up higher, $15 a barrel. But it's also going to impact industrial metals, right? That is a big part of the story too. Remember, China's the biggest buyer of commodities, full stop, right? But one of the big areas is industrial metals. People estimate that the price of industrial metals is impacted by China by like 50% of the story is China, right? So we need China back, and we need a China that comes back that will build, right? So the stimulus measures that Xi Jinping has done, which are great, but again, I think it's kept some of those builders out of bankruptcy. But we need them to still go back to building, right? So it's going to be interesting to see what kind of China do we get back when they reopen, and how are they going to reopen? And I think all of that is what we are waiting to see, right? But one of the banks put out a stat that was really scary. It said when China reopens, like if they didn't change anything, like they're at risk of 4 million people dying. Right. And that is a very large number. So that's why, it has to be done carefully. And Xi Jinping is making every effort to make that happen. So the big risk was the people over 80. There was estimates that
Thanks.
50% of the
Kathy,
people
one
over
thing,
80.
just coming to oil prices itself, right? Especially on a practical level, right? All of us driving basically and using oil, prices at the pump. How does that relate to oil prices? Because oil prices, as you mentioned, screamed up all the way to 100, $125 a barrel. It's back below where it started the year. Gas prices, not quite, right? So what's the disconnect between these?
So gasoline and diesel, right, are the commodities that have really they were much higher because of the refining capacity. One of the things that we did in the U.S. is we've massively decreased our refining capacity. We did that here in the U.S. and it was done as well in Europe. And remember, as part of this energy transition, like the feeling was we needed to close down some of these refiners, right? The refiners are very old, right? They're very pollutive, but it is causing problems, right? That we don't have enough refining capacity. So what are we doing? We're importing things, right? And that's the concern that we have, is that when gasoline prices, everyone wanted gasoline prices coming down, right? The current administration really focused on getting gasoline prices down, right? And as I said, the SPR release basically did that. And the refiners were very focused on producing as much gasoline as possible, but at the detriment of diesel. So then we came into, the fall, and in October, we hit a record low on diesel level for this time of year. So we're heading into the winter where we have heating demand, yet we're historically I think the number was all the way back to 1954, like to hit the levels since records were kept on diesel. So then the focus was all on diesel. And so now one of my colleagues was saying that they think that with the focus on diesel, we're going to go back to having issues with gasoline again and a shortage with gasoline once we get through this winter where the refiners are producing too much. But there's always going to be a lag on, crude oil coming down, gasoline prices going down. But they've come down. Gasoline prices have come down. But yes, right now crude is down more. But I would argue that that has to do with the refining capacity.
Kathy, let me jump in. Two things. You mentioned, the United States, releasing 1 million barrels a day. What is the global consumption of crude oil, or maybe how many barrels are made? Is it 100 million? I
It's just
swear I've
such an
heard the number
easy
100
number.
million
It's a
somewhere. Yeah.
it's a
Is
hundred,
it 100?
right? It's a
So it's
hundred.
100.
So I
okay.
love that because it's nice and easy
Yeah.
to remember. So when someone says, "Oh, it's at 104 or 109," like,
Mhm.
"Oh, demand's higher than the normal 100." But yeah, it's like trying to balance a
Okay.
market is supply around 100, demand around 100, right? So everyone's trying to manage that. But and that's what the
Got it.
concern is going forward, right? Do we have enough? We're watching demand, right? So we have demand increasing because of China. The big risk to the downside is a recession, a global recession, right? So, in theory, people are going to use less commodities if we go into a deep recession. So, people are arguing that Europe is already in a recession, right? And the US could be in a recession at some point next year. So I think Invesco's call is the end of next year, but that it will be moderate. So when we get hurt in commodities is when there's permanent demand destruction. When people really change behavior, like buying a more fuel efficient car or going on mass transit. And the story I love to tell was in the 70s when gasoline got really expensive. I'm from this very big Irish family. There's 7 of us. My parents bought a Volkswagen Rabbit diesel, right? So 7 people in that little tiny car. And that's what I would say that's permanent demand destruction. Right? And we're not seeing that right now. And again, we have to wait to see one, when the recession has officially started and what the impact will be. But there was great analysis done that goes all the way back to 1969. And they said once a recession is deemed to have started, from 0 to 5 months after that, commodities are still the best performing asset class. So we're sort of like a good place to hide out when a recession is deemed to have started. And then 6 to 11 months after, we're still positive when other asset classes are negative. We get in trouble where it's 12 months plus. So if you believe we're going to have a long term recession, right, then you might need to scale back on some of your commodity investings. And if you think it's going to be deep and really impact commodity demand, right? But again, we're calling for a moderate recession, so we believe commodities should be okay into next year and into 2024.
I love how you mentioned we when you referred to commodities. You've personified commodities in yourself, which is fantastic. But on that, like Ryan and I are always looking for signals. Oh, is there a recession? And we always get questions. Is there a recession coming? Has it started? So, and you mentioned if there's a recession, oil demand will obviously go down, right? I don't think that's fairly intuitive. But can we kind of intuit the reverse? Because oil prices have come down as much as they have, are investors expecting a recession? Or is it something else that right now demand is just below, there's more supply basically?
Well, I think that this current downtrend started with the big risk off, right? And this sounds sort of obnoxious, but I've said to people, who are you more afraid of, Putin or Powell? Right. So Powell comes out and says, okay, we're really 2% CPI. That is our target. I said, can you just say three just one time? But the 2% target, right? They're willing, right, to cause a lot of pain, right, to get back to that inflation target. And that's when I'm speaking publicly, and a lot of people say, well, the Fed, inflation. I was like, who's causing inflation? All of us, right? We're all buying stuff, right? The Fed's trying to send this message: stop buying stuff, right? Because we need to get these inflation numbers down. So I don't know, like this current market, I'd say that more of it is related to we're afraid of Powell. Right. And we believe that, yes, it is going to be painful. This transition, getting inflation down, is going to be painful. And we need to pull back in our buying. And so people are like, yeah, maybe people are going to drive less and everything. But again, fundamentally, we are tight. So it's that macro versus micro story, right? The macro is fear of a recession, right? All of the, some of the geopolitics, but the micro is we are tight fundamentally. As I mentioned, that 5-year average, like looking at those numbers, right? And China coming back and the SPR being so the micro fundamentals of supply and demand would indicate a tight market and that this is, again, a good entry point for people to be buying. But like that macro fear of it's going to be a recession, it's going to be deep, and these are raw materials. So again, people have to figure out what's their view on inflation, recession, and again, the real fundamentals of commodities.
So, Kathy, I want to go back to industrial metals. As we talked about, we didn't quite dive in, just so the listeners know. When you say industrial metals, do you mean things like copper, nickel,
Yes.
zinc? I mean, is that's kind of what you mean by
Aluminum.
that?
Don't forget
Aluminum.
aluminum. Aluminum is my
How could
favorite.
I
Yes.
can't believe I forgot aluminum. I apologize.
Or as my dad would say, aluminium,
Yeah.
right?
So there you go. That's right. That's
I
right.
would say aluminum.
Yeah. So let's dive into that a little bit. We've always talked about, we have an industry in general, Dr. Copper. So goes copper, goes the global economy. Copper has been a little on the weak side. I mean, do you believe that? I mean, I've seen honest to goodness studies go both ways on this. That's why I'm somewhat skeptical. But it makes sense if industrial metals, specifically copper, is strong. We're not going to have a global recession. They've hung in there. Can you dive in a little bit there?
Yeah, so all of them, right? The alley, the zinc, the nickel, the copper, they've all traded down because mostly of the China lockdowns and that fear of a recession. And you're right, Dr. Copper, right? Because people say copper takes the temperature of the economy. And so, and I generally used to be a big believer of that. Okay, but this is what has changed: the energy transition going forward, and the fact that we are historically low inventory levels off of many of these commodities. So, but as I said, China is really important to this story. So right now, if you look at just specifically copper, most of copper is used for building, right? So that's why that recession idea and the Dr. Copper. But in an energy transition, we're going to be using more copper in the build out of the grid, the infrastructure build out, the EVs, right? 4 times as much copper in an EV versus an ICE, internal combustion engine vehicle, right? So that a lot of us drive ICE vehicles, right? But maybe, in 4 years time, we'll all be driving EVs. So this story though is, and I heard a great stat, is that by 2025, it should be 50-50 demand from, this energy transition versus building. But right now it's more like 80 to 90, right? To 20 to 10. So right now it's still a building story. But when we are truly in that energy transition, then it will be more 50-50. And I currently believe like the IRA, the Inflation Reduction Act, right? A lot of that, again, historic climate change funding. And so I believe a lot of that money is really going to be used for this energy transition. And I believe that is supportive of industrial metals, right? The copper, the aluminum, the zinc, the nickel, right? Because we need all of those in this energy transition. And remember, copper mostly from Chile and Peru, like there's a lot of issues going on there right now, and issues about taxation and production and strikes. And so there's not a guaranteed supply. And the other thing with aluminum is aluminum, this is a stat that I also love. If the aluminum industry were a country, it would be the 5th largest user of power in the world, right? That's how much power it takes to go from alumina to aluminum. So, what was really the most expensive commodity this year? Natural gas. So, the thing that you use, natural gas, to smelt alumina into aluminum became the most expensive thing. So, 50% of the smelters in Europe, because that's where natural gas skyrocketed, were shut down, right? So, think about that: a lot less supply. Right. And now we have to see, do we have the demand, right? Is the recession in Europe going to hurt demand of the industrial metals because of like industry having to shut down? Well, right now they seem like they're doing okay, right? They've got all as much natural gas as they can store, they've stored, right, to get through this winter. And it was accommodative with the weather. We've had relatively warm weather in Europe, which has really helped them. So again, we've only just starting the winter, but we need Europe to get through this winter without having a big spike up in natural gas prices there, because they've borne a lot of the brunt of the shutdown of the Nord Stream 1, for delivery into Europe.
Well, I'll just say this. We probably have time for 2 more questions. This has been an amazing conversation today with Kathy Kriskey, the commodity strategist at Invesco. Sonu, you want to do one more question, and I'll have one more. It's amazing how quickly this went, but this has been an awesome conversation.
Now, but maybe I'll stick to the industrial metals thing because it's so fascinating, especially over the next cycle, right? Or next decade, even. You're talking about greenification and how that transition may not be as smooth, right? I don't think anyone expects it to be smooth. And there'll be demand for even fossil fuels, but even industrial metals, as you mentioned, for EVs and things like that, copper, aluminum. But a big part of whenever you think about commodities, geopolitics comes into play, right? It's such a big thing. We started the conversation, OPEC in US and the administration, what they're doing, all of it, right? Who are the big producers for some of these industrial metals, and how is that, how concerning is that, maybe countries that are not friendly to the US produce a lot of this stuff, right? And so are we doing anything, we as in the US, or is the US doing anything to counter that?
Right. And that is a big issue because a lot of people point to that in the EV world, that China is basically like the OPEC of those metals and minerals, right, that are essential.
Mhm.
So they control it, right? But that was smart on their part, right? Doing investing in that way ahead of some of the other countries. So, but we look to see, like, I guess the great example is like Australia. And so I was speaking to somebody at an Australian mining company, and they got a big influx of money from the US. And it was because they are miners of this, some of the metals used for this energy transition, but they weren't refining. And so now they have money to develop their refining because in the IRA, there's money for it's like $7,500 if you were to buy an EV, when a certain percentage of that EVs is the metals and minerals produced are sourced from either the US or countries friendly to the US. So that's why there's going to be, we're going to see a lot of that over the next 2 years, this big investment in countries that have some of the mining capacity, but also want to do the refining so that the thing that's actually used in making the EV will be sourced from a friendly country. And I think, again, the current administration is limited in terms of what they can and can't do, but I think that was a move in the right direction to develop more mining and refining here in the US as well as countries that are friendly to the US.
No, that's
Interesting.
great. I mean, yeah, Kathy, I think we've reached the end of the line here. I've got maybe one final question for you. I just want to thank you again for coming on the Facts versus Feelings podcast. Great partners in Invesco. It means a lot to us here at the Carson Group, and we're going to continue to do this stuff, and we'd love to have you back on. So last week, we had our podcast, and we did a little bit of an 80s hair band theme. Kathy, are you all an 80s hair band fan? And if you are, which one do you like?
Oh my gosh. I used to
Yeah,
love Kiss, right?
there you
With
go.
the
Ah,
crazy, the
there you go.
face
Yeah.
makeup and everything. But I thought it was interesting because we never recognized those guys out of makeup and,
True.
hair. But yeah, I love the 80s music. That was my time. So I got out of college in 87. So it was very fun time. I love that theme.
There you go. Yeah, that should have come on
Ryan's
last week.
got that.
Yeah.
Ryan's got that stuck in my head now.
Yeah, exactly. So, Kathy, last question. We talked about this before we came on, so I'll make sure you say whatever you're allowed to say. But you do some really cool, I hate to say trips, work trips, like to the Middle East to learn more about this. Can you just tell us a little bit more about kind of what you do when you do those and when the next trip is?
Yes, we're going in January. And again, they have a very interesting perspective on energy, and they're very focused on the energy transition, right? And one of the best things I heard was when we talk about energy and the necessity for energy, we really need all of the above, which includes renewables, fossil fuels, nuclear. I know everyone doesn't like nuclear in the U.S., but I think in the Middle East there is an acceptance of we need all of the above, and I'd encourage people to understand that there has to be redundancy in energy, right? We use energy all day, every day. Everyone uses it, and every industry is somehow impacted by energy. And that's why I think like the best thing about traveling around the world is understanding a different perspective. And again, in energy, we need all of the above.
That's great. Well, Kathy, thank you once again. Sonu, great conversation as always. Guys, this was a good one. We hope you enjoyed it. We'll be back next week with the next edition of Carson's Facts versus Feelings podcast. Until then, happy early holidays, everyone, and we'll talk to you next week. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.